at the standard deviation, it's coming in at 34 as well. If we go ahead and sort this, that is not quite the highest, but definitely among the higher standard deviations. For those of you who haven't attended a statistics class in recent times, know that standard deviation is a measure of volatility. Specifically, if we compare it against the returns, we're saying how close have those 5 years worth of returns, or in this case, 3 years, how close have those 3 years worth of returns stayed near to the average, or has it been widely dispersed? Are we shooting this with a sniper rifle at very effective, well done aiming, or are we using a shotgun approach, very widely dispersed, hitting everything in the area? If we go ahead and look for lower standard deviations, it turns out there are some that are almost so predictable as to say they are guaranteed. These are paying out about 2% per year, 2.8%, with hardly any deviation from there, at least over the last several years. These funds would be very different in characteristics to those that had higher returns or higher risk involved with their returns. Finally, we can take a look at the technicals and analyst opinions columns. I won't waste all of our time, Constantine, because I know we've got many other ideas that we want to take a look at. But this is a starting point to help you understand how much information is available to you as we seek to find how these funds are performing. One final little filtering idea is to say, all right, let's compare how these are moving in relation to their current moving averages. I've now sorted it as the percentage difference away from their simple moving average of a 200-day. Currently, SMH, which we saw previously as a high performer, is 36% above its 200-day simple moving average, implying that it has been, at least, on a very strong long-term positive trend. If we look at it in comparison to the 50-day simple moving average, we may still find that SMH is towards the top. But if we compare it to the last 20 days, we might see that these shift, and now we're looking at an entirely different set of securities. In this case, I happen to know that's because semiconductors, NVIDIA included, have suffered quite a bit over the course of the last few trading sessions, amounting to a substantial decline, but only in the most short of terms. That change in perspective is certainly something to be aware of. Now, Constantine, there's 100 different criteria that we could take a look at on this, so I won't belabor the point. Anything specific you wanted to add in as we look at how to find some securities to include in our universe of optionable ETFs?
Hey, Jake, thank you so much. This was fantastic. Folks, the reason why this is very important is because this would be the tool where you would come to find the weapon of choice, right? So if you are looking for an options related strategy, you have to find the underlying first. And so you maneuver this thing to the nth degree until you find what is appropriate for you to choose. Now, from here, Jake, we're going to dive in specifically into options related information, which for me personally as a trader doesn't, my rules don't make it absolute, but I certainly would like to share with you some of the thoughts that I have when I normally filter and look for things that are opportunities potentially. We'll talk about liquidity. We'll talk about tradability. We'll talk about volatility. Okay, so different types of things that are very option centric. There are a few people that are requesting for us to take a look at the Qs. That's totally fine. We can do that. Qs are an extraordinarily liquid product. More on that in just a few moments here. But the idea, folks, is that you start by getting to know the underlying, its personality, before you hop over into the options world. Now, Jake, there were a few people in the audience throwing in comments about the semis. SMH being what, 36, 37% above the 200-day simple moving average, right? It's a total buy today, right, Jake? Leverage up, full throttle. I mean, today's got to be the day. Of
No
course, I'm
risk
saying
somehow,
that.
isn't
Please
it?
take it with a grain of salt. I mean, it is extraordinarily extended and it's still up 2% today, outperforming to the upside of the broader market overall after suffering a pretty decent sized drawdown. But it is very extended. Anytime that you are extraordinarily extended, either to the downside or the upside, away from that institutional level of interest of 200-day simple moving average, it's worth to be aware of that factor, right? When you're constructing things. So if you are deciding to trade some idea using SMH as your weapon of choice or your underlying, maybe defining your risk is a fantastic idea using options. Right? Risk-defined strategies that take advantage of your view. Bullish, bearish, neutral. Okay, so forth and so on. So let's hop in here. So Jake, first, I'm gonna pop into fidelity.com and say, yes, it is important to be aware of the expense ratio and the tracking error and the total market return and its differences. But what's more important to you as an options trader is going to be none of those things. What's going to be most important to you is that the underlying is extraordinarily liquid and the options market is liquid on that underlying. Okay, so here I have an example of 3 exchange traded products that are very large in terms of their assets under management. SPY having $533 billion, VOO, the Vanguard product, $455 billion, IVV, BlackRock, iShares, $462 billion. So they're pretty darn close in terms of assets under management. But what about volume? What about liquidity? What about performance? So let's hop over here into traders world. Where is the volume? Where is the liquidity? SPY, 11, 12 million shares so far. VOO, 2 million shares. IVV, 1.1 million shares. Yes, they are all optionable. But clearly the one that has the most volume is very likely to have the most liquidity in the underlying, in the options world. Okay, so vetting things in this fashion, it doesn't mean that you can't trade options on IVV or VOO. Just be aware of the fact that going to the most liquid product, even though it might be more expensive to own if you own shares, you don't really care about owning shares because that's not your plan. You're trading options on it. When you're trading options on something, you're not paying the expense ratio to the money manager. As long as you're not going through expiration with calls or puts becoming short or long stock, you don't really care about that thing. You care about liquidity. Then you hop over into Active Trader Pro and you say, all right, well, let's say that I'm thinking about August as my expiration, as an example. Going to the most liquid underlying is going to be important. So I'm going to bring up option statistics here and go through this exercise. And by the way, if you choose QQQ and you want to compare it to equivalent products to QQQ, you can do the same thing. Find 3 or 4, compare and contrast, and you're going to see the differences vividly in your own view. SPY, trading 13, 14 million shares so far, has traded 2.7 million contracts on a daily average volume of 7.5 million, and we're through about half of the day's worth of trading. So it's tracking on about average, slightly below average volume today. Let's go to VOO. 988 contracts with a daily average of over the past 90 days, less than 2,000. This one, you bet. If you're going to be trading VOO options, you're probably going to be one of the only ones out there today in this marketplace. IVV, even worse, 136 contracts on 675 average. Which one are you going to be choosing if you are trying to create a strategy trading S&P 500 strategically using options? No brainer. The most liquid. Okay. Next, What else could I share with you from the secret cove perspective as a trader? Well, get your pencils out, get your pens out, get your screenshots out. We're going to be taking some screenshots here. I'm not going to walk you through the process of how I dug up this link. All right, you're going to have to click on about 30 different things on Cboe's site. But go ahead and take a screenshot of this link, copy it, and paste it into your browser. Third-party source, of course, but a very trustworthy source being the Cboe, right? Chicago Boards of Options Exchange. Where does this link take you, and why is it important? Why is Constantine talking about it? If you go to this link directly, what it's going to do is it's going to take you to a very special CSV file with a ton of underlyings in that file. Close to 5,000 underlyings in this particular file. And by the way, the updates are going to be live each and every day. Each day that you plug in that link, it's going to give you the updated information with the most up-to-date stuff. Why is this important? Well, the important columns here, folks, are going to be, I mean, some of you might be interested in stuff like this. Like, who's the designated market maker in a particular underlying? Is it Citadel? Is it Belvedere? Is it Wolverine? Whatever, right? I mean, this is the kind of geeky stuff that Jake and I might be interested in looking at. But the important thing on this list is going to be this column, column G. Is it eligible for extended hours trading? Yes or no? If the answer is yes, that means that exchange traded product will be trading through 4:15 p.m. Eastern Standard Time each and every day. Not through 4 p.m., but through 4:15 p.m. So it gets a little bit of an extra window. Now, that is very important, Jake, because a lot of things could happen in extended hours in 15 minutes, especially on days where 3 or 4 massive market capitalization companies report earnings, for example, right? So speaking of the queues, Christine, imagine Apple, Meta, Amazon, and Microsoft going, reporting earnings all the same day. And we've seen that happen. Depending on what they report and how it goes, maybe not Apple because they're kind of old school and they wait for an hour or whatever, 45 minutes, but you get the point. There could be a lot of market movement in the extended hours, and your options are still going to be trading. By the way, they're going to be trading even if it's the day of expiration. So the settlement value for the moneyness of your strike at expiration is going to be based off of the closing price. But those options will still trade until 4:15. Anything could happen. Are they going to be in the money? Are they not going to be in the money? Are they going to be exercised or not? Those are important things to understand, right? What's the next column here that you should be paying attention to? Tick type, column I. How does it trade? Does it participate in the penny pilot program with the Cboe or does it not? Does it trade in nickels and dimes? Nickels below $3 in premium? Dimes above $3 in premium? Or does it trade in pennies across the board? So is it a penny-wide market or is it a nickel-wide market? That's important for liquidity purposes. And again, you can, with Jake's special skills, for example, of Excel, you can manipulate this sheet in any way you want, right? Hey, sort out the things that are extended hours eligible, sort out the things that are penny-wide markets, and those might be the things that you're focusing on day to day. Update the spreadsheet maybe once a week, once a month, depending on your preference, to see what's coming onto the market new. Maybe something is changing. Is it an equity? Is it an exchange traded product, right? All of this stuff, all this information is in this sheet. And again, fantastic resource to have in your pocket. Again, I'm going to hop over to give you this link. You can screenshot that and plug it into your web browser each and every time that you're trying to get an update. What else am I going to talk about here today? Jake, naturally, the more liquid the underlying is going to be, the more expirations you're expected to have on the board. Okay. The more people are interested in trading a product, the more market makers are willing to make markets in it. Whether it's just a designated market maker or several designated market makers, or, right, people who are transacting in this beautiful, free capitalistic market that we have here in the United States. The most liquid market in the world, by the way. Let's talk about the expiration selections and the availability of them. And again, this conversation about penny wide markets versus nickel wide versus dime wide or further. The tighter, the better. As an options trader, the cost of doing business is not the commission cost that you're paying to Fidelity, which is what, 65 cents a contract with a little bit of a tiny sprinkled on top or fee, options regulatory fee. That's not the cost. The cost is the spread. Each penny between the bid and the ask to you as an options trader means $1. 1 penny is more than the commission cost that you're paying to Fidelity to execute your order. So what's the true cost, the barrier to profitability, or the exacerbator of false narratives and losses, right? It's the spread. That's how important it is. Now, if I hop over into, let's say, something like VOO, are there going to be markets there? Sure. Are they going to be penny wide? No. Are they tradable still? Yeah, we could argue that they're tradable. It's just that the bid offer spread is 40 cents wide. So what's the true value of an at the money contract or an in the money or an in the money contract, right? For calls or puts. You have no idea what the true value is. You kind of have to throw in a limit order, hopefully, right? Not putting in a market order to find out. Like the market maker is basically saying, that's my bid and that's my offer. The bid is the most I'm willing to pay, and the offer is the lowest I'm willing to sell it for. So if you don't like the bid offer, come and try me. Tell me what your bid is. Tell me what your offer is. And then we'll see what I'm going to do about it. If there is a lot of competition, and that's what we want as traders, we want a lot of competition from market makers, from market participants for order flow. We want the tightest markets possible so we can get in and get out without a lot of slippage, without a lot of transaction sunk costs, if you will. If I hop over to IVV again, is it tradable? Sure it is, but there are also 40-cent wide markets. There are 3 or 4 contracts that traded on the volume, nothing really on the open interest. The availability of expirations, as I mentioned, that's something that market makers and market participants decide. Which ones are going to be listed, how wide the strikes are going to be is decided by the exchange, right? By the exchange traded product provider as well. So if SPY has $1 wide markets in monthlies, and by the way, 50-cent wide markets in some weekly expirations, that's not going to be available, right, for underlyings across the board. There are a few exceptions, like I showed you on the prior list, SPY, QQQ, and IWM. They trade in pennies across the board, up and down the strikes and up and down expirations. So you can trade them in penny-wide markets anywhere you want. They are exception to the rule. Most underlyings have that nickel dime pricing. If it's underneath $3 in premium, it's trading in nickels. If it's above $3 in premium, it's trading in dimes, mostly. The Penny Pilot program for the SIBO, and you can read more about it if you would like, is the type of a thing where it's 5 cents above $3 in premium, pennies below 3. You don't need to know the rules, right? You're not taking a multiple choice test. Just look at the option chain. It's right there in front of you. It's very evident and understood. Jake, we got some more interesting stuff to share. So now I'm going to get into the weeds here. What are the types of things that you need to be aware of and make yourself familiar with if you are going to be trading options on exchange traded products? How many of you attend the volatility primer sessions that I run on Wednesdays? By the raise of hand, I'm curious. So quite a few hands going up. That's good. If you're attending, you're well versed and well aware of a concept that is known as implied volatility skew. Now, for those of you who don't attend, which is the absolute majority in this particular class, what I'm sharing with you today, or right now, is a screenshot from our partners, sponsors almost, if you want to call them that, right, of the trading strategy team in terms of their product. This is Livol Pro. Livol is a Chicago Boards of Options Exchange subsidiary. They have a platform, a trading platform, that is very nuanced and geared towards professional traders and investors. What I'm doing right now for you here is showing you some of the tools that are not available, unfortunately, currently at Fidelity, period. Now, I hope that at some point in the future, based on my feedback and hopefully your feedback, if you're going to start getting interested in stuff like this, is going to change. But for now, let's talk about what is appearing on the board. We have a chart of SPY at the top. We have its volume down here. What is this? This is the difference between implied volatility, the cost of options looking out 30 days at the money, versus the realized volatility of SPY over the past 20 trading sessions. Realized volatility is just that. It's realized. 20 trading sessions is about 1 month worth of trading. Implied volatility is looking out on the calendar, hypothetically 30 days from now. We don't trade on the weekends, but we have to account for them. The weekends are there, they're in the future, but options are based on calendar days in their implied volatility terms. So to compare and contrast one versus the other, I'm saying what has been the realized vol over the past month versus what is implied over the next month, and what is the differential between the two. That is important because if there is a really large spread, there could be an opportunity. Are options overpricing the movement that is being realized by the underlying, or are they underpricing the movement? Am I going to be a buyer of volatility or a seller of it? How am I going to position myself? Again, this is not a volatility class, and we run dozens of hours of volatility-related classes on a monthly basis. If you're interested in this sort of thing, right, and learning more about it, plug into those particular sessions. But the key component of what I'm going to be talking to you about right now is the skew metric. So what is the skew? And I'm going to show you several markets where skew is different. What is skew? Fancy word for difference or different. What am I looking at here in this yellow mountain depicted on the chart? I am looking at similar delta out of the money puts and calls, and I'm comparing their values in implied volatility terms to each other. I'm trying to figure out which ones are more expensive. Are we normally distributed, meaning puts and calls out of the money equidistant are par or similarly priced? Or is there kurtosis to our distribution? Are puts more expensive or are calls more expensive? Left skewed, right skewed, negatively skewed, positively skewed. Why is that? Why does that matter? It matters because when you're constructing strategies using options, you have a direct exposure to this circumstance. If you're buying puts or you're buying put spreads, you want to know if downside out of the money puts are more expensive relative to the ones that you're buying or selling, right? And vice versa. So what is the circumstance here? The normal skew of broad-based index markets like SPY, QQQ, and IWM is going to be a circumstance where puts are more expensive than calls. So positive skew over time, yes, it's different and it changes, but it doesn't change dramatically. It's consistently positive, and that's telling us that puts are consistently more expensive than calls in SPY. At times when market gets really wonky and falls out of bed, puts get a lot more expensive relative to calls. And when markets don't really have a care in the world and they're sniffing the roses, walking in the park, that skew gets really tight, closer to zero. The differential here, of course, is implied volatility term. So if my 25 delta put right now in SPY is 12 volatility, annualized 12%, my call is less than 10%. So the net difference is 2% positive puts to calls. Now, let me hop over here into something that is a little different in terms of skew. You need to be aware of this, right? Let's say it's TLT, the bond market. It goes up and down below and above the zero line all the time. So in this circumstance where we are right now in the bonds, what is more expensive, calls or puts? Calls are more expensive. You need to make a determined observation of what you think is going to happen here. How do you want to position yourself? If you're thinking the bond market is coiling in this triangle, and whenever this coil is going to break up or down, whichever way you're biased, it's likely to go with gusto. How are you going to position yourself? Do you want to be bearish using bear call spreads, bear put spreads, bear put butterflies, or straight up puts? Or vice versa, right? If you want to be bullish, are you going to be a bull put spread seller, a buyer of bull call spreads, a buyer of bull call butterflies? If calls are more expensive than puts, then there's likely upside skew here. So maybe creating something structured to where you're not just outright buying a single leg, but creating a multi-leg strategy makes sense. Now, you're going to hop over into something that is even more nuanced. Let's say you're looking at USO. Now, this product gains positive correlation to the daily movements in WTI crude oil. Now, why do I say positive correlation, but not the exact performance measure? Because USO does not own the front month future holistically. It owns a weighted version of future expiration contracts in WTI crude. But it does have a very positive correlation to what WTI is doing. Now, what do you see here? Normal circumstances over an intermediate time horizon is that puts are more expensive than calls. Puts are more expensive than calls, but that's not always the case. When oil was going ballistic over here in March, April to the upside, look at what was going on. Calls were way more expensive than puts. And if you were seeing a trend break and a deterioration, right, of performance in oil, and let's say you wanted to be bearish, it made a lot of sense to be a bear call spread seller there instead of buying puts or buying put spreads outright. Those types of ideas, right? And again, I know that I'm probably going into some complexities here that if you are exposed to it for the first time, it might be going over your head, but hopefully you're getting the idea of why it's important to familiarize yourself with the product and its normal behavior. If I'm looking at GLD, what's the skew like? Historical vol is way above implied, and the skew is consistently negative. That means calls are more expensive than puts. It's a commodity, right? It makes sense. there is certainly an intrinsic value of sorts in a commodity like gold. So upside calls ought to be more expensive than downside puts because there's a floor, right, underneath the market in gold at a certain level. Looking at something like silver, let me hop over to SLV here. Look at SLV, how drastic that point is of how upside calls are significantly more expensive than downside puts. So, folks, point is, markets are different. Exchange traded products of your choice are different. A lot of you are probably saying, well, Constantine, we're not paying $500 to have a Live subscription on a monthly basis, right? For the SIBO. So is there any information online that is available? If I'm not attending your sessions, Volatility Primer on Wednesdays, right? Or I can't attend frequently enough to ask this question. I don't understand how to read this stuff. Are there sources online for free that give me similar information? Answer is yes. I'm going to share the source with you right now. It's not a Fidelity source, so I have to be careful here. But I'm going to go ahead and share it because, quite frankly, Jake, I don't really care. Market Chameleon is one of those sources. I'm not a paid employee of Market Chameleon, right? I'm not getting commissions from them, but it's something that you should be able to use on your own to get very similar charts of what I just showed you. So I just typed in SPY. How do I get there? I'm going to go to my volatility mechanic here and click on skew. And when I do that, I can see what my 25 puts, delta versus calls are worth on that similar scale. You can add the implied volatility to it. You can add a moving average to it. You can look at IV skew by delta. You could look at the graphs of implied vols on different days. I mean, listen, this product is pretty awesome. Granted that if you want to get up-to-date real-time information, you have to subscribe to their paid model. But there is a free version of this thing that I'm showing you right now that you can use if you're not, constantly monitoring this thing for opportunities. Click on the feedback tile on Active Trader Pro or Fidelity.com and let the developers know that these are the types of things that you would like to see being developed instead of some of the useless stuff that they might be working on right now. Jake, over to you, sir. We got 17 minutes to go.
All right, sounds good. Let's go ahead and take a look at a couple interesting ideas. There is one tool that I'd like to show on Fidelity.com. It takes a little bit of wiggling to find it, but we'll get there and take a look together. So if we go ahead and come up here to News and Research and then come down to Options, we're going to be presented with a new options chain that's been developed and released. Pretty neat stuff showing up. But if we want to access this specific tool that I'm talking about, we're going to need to either return to the classic view up here, or we need to plug in a symbol. For example, we could take a look at NVIDIA, and then right down here in the middle, we'll have the option chain show up with these little three-dot menus. When I click on it and then click on options trading ideas, it's going to take us to what is known as the market scanner. This is going to allow us to scan the options market for potential trading ideas for both predetermined scans that have been created and are available to you, as well as custom built scans that you can put together based upon things that are of interest to you. So let's first take a look at some of the scans that exist pre-built. For example, the first one listed is the high option volume. In fact, that's what we are looking at presently. And it shows us that there is a large portion of volume on Patterson UTI energy showing up today. And by looking at the criteria over here to the side, we can learn that it's high option volume today relative to the average. In fact, we're getting 90 times the activity today at 66,000 contracts compared to the average of 733. Substantially more activity showing up on this security today. That tells us for some reason this is in the spotlight today. We don't know if it's good news based on this. We don't know if it's bad news based on this. And in fact, looking at the comparison on the price, it doesn't look like it's a huge change in price day, and yet substantial activity showing up. Maybe you take a look and see, all right, what's happening? But as we scroll through, we'll find all sorts of different possibilities. We also can come down here and take a look at the top option scans and see, all right, what are those securities with the highest open interest? Where is there a lot of open interest currently? Again, it's going to take this and compare against some of the other volume and attributes. HYG showing up with a huge amount of open interest currently, but again, it tells us that we are looking at compared to the previous trading day, and we're looking at a couple of different ideas in terms of that change in it. If we go down here and take a look at implied volatility, we can see things that are increasing or decreasing over a certain period of time on its implied volatility. Maybe for situations like Constantine just outlined, comparing historical volatility, the HV, versus the IV that might lead us towards one strategy or away from others. And we can even take a look at the order flow. Is there more calls being bought in on the offer or puts being bought on the offer, pushing the premium in one direction or another? But now I'm going to take us instead into the custom scans. Here, you'll be able to click Create New and create a scan of your own liking. This is certainly the way that I have found the most value from this particular tool. You can click Create New and plug in the details that are of interest to you. I'm going to open up the ETF options custom scan that I created this morning. When we do, it immediately simply scans the market based on some of the criteria that is involved in our particular scan, and it reminds us that it's only going to show 100 rows even if there was other information. If I were to click on Edit for this option, now we start to see the real power here. I chose to have it display for me the company name in addition to the symbol. I also wanted to see the closing price, the most recent close price for the security to give me an idea of the purchase price. I also grabbed in and included securities that are in the 52-week percentile of 80 or above the minimum value for the 52-week percentile. So between the 52-week high and low, it's got to be at least at an 80 or above. Or in other words, it's within 20% of that 52-week high. I just chose to have that as the sorting criteria, making this descending from there. So you would find when we pull up the scan again that we're going to find at the top of the list those that are the nearest to their 52-week high. The IV 30 percentile. In this case, I chose to put a maximum value at 50. In other words, saying what's got low implied volatility currently. Or we could take this from that column and put it over here on the other side. What has high implied volatility, even though it's near highs? Your job is to say, this is what I'm interested in. Let's see how this changes by flipping it over here to the left-hand side. Then I have a couple just filtering criteria to say, you know what? I don't want to see something that hardly has any trading volume. Constantine showed us some great examples of the types of bid-ask spreads that you might see on a security that only trades a few thousand contracts per day, even if the ETF is substantially liquid in and of itself. Then I've added another criteria, and this one I unchecked the box. This column here is to show or not. This is a trick available to convince this scanner to limit everything that is a stock and only show me things that are not stocks. So you would notice that by putting our maximum market capitalization at 0, then the things included are going to be either ETFs or indexes, because those do not carry a market capitalization in the same way that a stock would. Finally, the average open interest is telling us, all right, how many contracts have remained in force. So we've got some criteria involved here. If I hit save scan, then it will run the scan for me again with a new changed criteria. It turns out there is only one that is above the 52-week percentile of at least 80% and has higher than the 50% implied volatility. And it turns out this is that same one that popped up in a few other places that we talked about, SMH.
Jake, I'm
So
telling you, it's a sign, my friend.
it is. What does this tell
So
us, folks?
Christine's request, right? She asked you to take a look at SMH, so why don't we?
Yeah, we're going to take a deep dive here. Take a look why this would be the case. Ask yourself first if you can answer why this would be the case. This security is near all-time highs. It's within 20% of all-time highs. And yet, people are more concerned presently than they have been on average in the past. They're paying 64% of that implied volatility in terms of its range. Let's go ahead and jump back over to Active Trader Pro. We'll come to the option statistics and look at SMH in a little greater detail, seeing that it popped up here on the list. Here it is. We can see that right now, the implied volatility 30, the number that we were using to compare, is at 30.47%. That ranges from 21 at the lowest over the last year and 35 at the highest. That puts us right there at that 64%, right in the middle or high on the implied volatility scale over the last year. We look at its realized volatility, the orange little boxes down here, and see that it's had a range fairly similar to the implied volatility range, the blue boxes up here. But currently, that HV30 coming in at 28.48. But take a look at the other characteristics. Clearly, SMH is getting pretty substantial volume. A lot of securities traded on the underlying itself, almost 4 million so far this morning, 64,000 contracts being traded this morning, plenty of eyes watching this and clearly impacting and creating a decently liquid market. It's average at 91,000 per day, and the open interest coming in at 900,000. A lot of contracts in force here. But if we were to take a look at the chart for SMH and think through some of the implications for it, why would this be the case? Why would tensions be high, options premiums be getting juiced up as the recent activity has occurred? Well, I'd tell you some of the things that would be on my mind if I was taking a look at this security. One thing I'd be watching is this trend line, lining up here some of our recent lows, coming through our most recent pivot, and though today has made it a little bit sideways, even a little bit positive, when I checked earlier in video, which is a strong component of this particular ETF, was up about 5%. It looks like it maintains that thus far today. That's pulling positively on the semiconductor ETF today. But we were just barely at all-time highs, and in short order, 3 trading sessions, we found ourselves down 8.5% or so. That's a quick change of pace. From all-time high to 8% down 3 days later, it certainly is concerning. Today, stabilizing just a little bit, and that's a positive thing. But you're still balanced on the edge of this proverbial knife, watching to see what happens next. If you get a little bit of additional selling, would it be reasonable to say that this magnitude of directional move could show up or even increase? Absolutely, it could. That would mean driving us back down into the 240s or perhaps below in quick order. That's why there is concern, because options traders are not ignorant of the fact that there has been an outstanding uptick in the recent volatility. If we go ahead and pull up our volatility indicator, we can see some things similar to what Constantine has just showed you on the third-party resources. It'll take just a half moment for it to load. But here we can now see information about the IV30 and HV30 showing on these charts down here at the bottom. There's a few peculiarities showing up on these for some reason, but as we take a look and even them out over time, we can see how this has ranged in the last while. If I expand this up a bit greater so we can see again, and I'm going to go ahead and flip over to another security and then back and see if reloading this makes any difference. Now, it does look like for some reason this did spike up in a huge way, at least on this quote. Constantine, I'm not sure if that's a verifiable quote or if that's something of a
Looks
failure
wonky
from
to
the
me,
data
Jake.
provider.
So,
I'd agree with that.
probably a data feed issue. I can definitely report it, but we're gonna have to deal with it for now at the very least. Looks the same on
Absolutely.
my chart.
Excellent. All right. So as we take a look, our most recent volatility at 30.51 is represented, and this is what the shape of that volatility has looked like over the course of the last while. Exclude for yourself these ones visually and think about the rest of the movement as we take a look, and we can see how this has reacted over the course of time. There was only a small period where we had higher implied volatility than current. Over here, relatively similar to what we're experiencing right now. And the other time when we actually did supersede this and got into the 34 and 35% implication of volatility was right over here. Let's just take a brief look and dive into that time frame. If we look at this period on the chart, we see some dramatic similarities, including a strong positive trend, and then suddenly, out of it felt like nowhere, an 8% decline over the course of, in this case, 2 trading sessions. A huge pullback, and it happened almost immediately. What happened in that instance? As we glanced forward, sideways or negative action for the next month or so of additional trading. Now, knowing what came after now, we see that there was a more dramatic pullback. It came down in the end from its highs almost 18% or so before finding this extra strength starting in April, going through until this just recently pullback. This is the stuff that you're concerned about as an options trader and watching to see. I can't believe that time has already gotten away from us, Constantine. Any other thoughts you'd like to tie in as we come into the close of the session?
Yeah, Jake, I'm gonna go out on a limb here and in the last 2 minutes, maybe structure something that might be interesting, and look, this is not a solicitation or a recommendation of any sort. But if you are thinking about all these concepts, whether it's SMH, look, we can talk about SPY, we can talk about QQQ. The idea should be the same. You have a process for saying, what do I think is the most likely scenario from here? If you are in a bull camp and you think that this pullback was warranted because things got ridiculously overheated, but it's going to stabilize here and it has the potential of maintaining its trend and going higher, how would you take advantage of that, given the current implied volatility environment being relatively expensive in SMH? And maybe you want to define your risk, saying, it's a $260 underlying. If I want to get 100 deltas, I got to put down 26 grand. But I'm not willing to put down 26 grand worth of capital to this idea. I want to use a fraction of that, but still gain some exposure. How would I be able to do it, right? So, Jake, I'm going to go out on a limb here again, and this is not a solicitation or a recommendation. I want to emphasize that, okay? But we're going to go ahead and build something out that might be pretty interesting. So based on some of those levels that Jake just alluded to or mentioned, remember what we talked about, right? Implied volatility, skew, liquidity, all of these things matter. So let me look at 220 to 310 or so. So I want to incorporate some additional strikes in here. And some of you are asking, well, if I'm not using Market Chameleon, third-party source, don't trust it. If I don't have Live Pro, if I don't have Bloomberg, if I don't have XYZ, right? How can I see the skew? Can I see the skew using Fidelity tools? And yes, you have to kind of use your imagination a little bit here, right? So if I'm looking at August, 52 days out, and I'm looking at the money options, 260, that implied volatility midpoint, just shy of 31, just shy of 31, that is my at the money implied volatility. So Jake's earlier observation, right, of 30 to 60 day vol being around 31%, 60 plus percentile, that's where we are. Now, visualize this. If I go out $30 lower, what's the implied vol of that put? Almost 34%. So as I go lower in strikes, my puts get more expensive in volatility terms. How about higher? Go out to 290. What is my implied volatility of that call? Doesn't change. In fact, it reduced some from at the money. So my implied vol of puts is 4 percentage points more expensive than my implied vol of calls. Right? So if you just want to be a flat out bearish, understand that the further out you go by choosing the strike that you want to buy put-wise, the more expensive it is. That's, by the way, no different than it is currently in the S&P 500 or QQQ or IWM. And it's not like you personally can affect this or change this. It is what it is. You get to trade the market that you're given, not the one that you want. So how can you be a little bit creative maybe, right? Using this skew, using these differentials to figure out what strategy might be interesting. So if I want to be bullish, I don't want to pay an arm and a leg, and I want to define my risk, one of the strategies that I think is plausible for me personally, remember, you're not biased. Well, you can be biased if you want to, but you're not biased to be bullish or bearish from the onset. You can do whatever you want. You want to be bearish, go for it. You want to be bullish, go for it. You want to be neutral, absolutely. The world's your oyster, right? So how would I structure something? Maybe I would do a bull put spread right below the market, 10 points wide. If I do that, I can get a $3.50, $3.55 credit for a $10 wide market slightly out of the money below. So I'm defining my risk to $1,000. I'm bringing in $350 worth of credit, right? In order to do that. What I'm then going to do is I'm going to turn around and say, let's take a look at that chart again. So we're currently at 260 in SMH. We topped out at 280. A sharp pullback right to the 20-day simple moving average. Notice I am choosing the strike, the short strike, right on the 20 MA, which is the last couple of days worth of lows. I'm not going to be very likely holding on to this position if that 20-day simple moving average breaks with a lot of gusto. I'm going to be managing that risk. Yes, I've defined my strategy to a $1,000 loser on a $350 credit with a $650 maximum loss potential. But I'm not going to sit there if this thing breaks down below today's and yesterday's lows and keeps going. I'm not going to be holding it to a max loser position. I'm going to be managing it. But what else am I going to do? I'm going to go out there. I'm going to say, I'm going to go ahead and use that credit or a portion of that credit to structure a bullish call vertical above. So I'm going to sell a 10-point wide put spread, and I'm going to buy a 30-point wide call spread. And I can do this thing for a net debit of less than $6. So if this thing, in fact, does go to prior all-time highs or higher, I'm going to be participating in that. My break even would be 265, 266 bucks. And anything above that upwards towards 290 is pure profit. This is a structure that really might be interesting here. Again, as the market, if SMH decides to go lower, by the way, could you make it tighter? Could you say, hey, how about don't go out too crazy and not go 30 points wide, but do 20 points wide? Yeah, sure. But think about what you're giving up versus what you're gaining. I am paying approximately $2 less for the structure, $6 versus 380. But I'm giving up $10 of potential upside in case this thing continues to moon to new all-time highs. Is it worth your while? Asking that point, putting down a question mark saying yay or nay. Everyone is different.
And Constantine, for the folks that are a little newer to multi-leg options, let me
Yeah.
just remind you, this would represent buying. So you're paying $4.15 net, but you do have that spread in there, the short put spread, which would lose if it goes down. So this is a decidedly bullish strategy. It's selling the puts in order to help pay for the calls. So our worst case scenario is that the opposite happens, right? If it goes down, that's where we have our risk. And if it does go down, what would this look like? This would end up being a loss of the $10 difference between our put strikes and the initial money we put up front. So worst case was either a $16 loss or 14 if we went with a $20 version. So hopefully that makes sense for those of you. This is a little newer. I know that's a lot to swallow all at once, but a really interesting potential as we take a look at how to take advantage of skew distributions and where we're sitting depending on your own directional bias. This one, a bullish directional trade.
Yeah, Jake. I mean, I know that sometimes I can go a little fast, right? And I certainly want to recognize that. So my suggestion is if I'm going too fast and over your head, build this thing out in the profit and loss calculator and then size it up to your own risk management, risk reward potential. So I'm just plotting these in at midpoint prices and applying. Here I have the structure that I've created. This looks interesting to me. So what is my maximum loss potential? $1,610. That is the circumstance if the market, if SMH goes below my break-even point on the downside, short strike 245. Anything below 245 at expiration, I'm at max loss. Can't lose any more than that. Anything above 260, I'm in profit. Okay? Between 260 and 266, I'm starting to crawl or claw at my break even. Anything above 266, I'm in profit all the way up to 290. What's the maximum profitability potential? 2,390 bucks. So effectively, it is approximately, right? It's less than 2-to-1 reward to risk. But it's interesting because what happens if SMH just maintains its balance? And I know that we're way over time here, Jake, right? This might be a little too much for me to lay on to people, but this is what trading is about. This is why it's exciting. What if SMH just sits here for 2 weeks? Doesn't move. Moves a little bit higher, comes back. Moves a little bit lower, comes back. If that's the circumstance and SMH just goes to sleep, loses its momentum, and oscillates, consolidates, what does that mean to my P&L? It means nothing. I'm losing 70 bucks. Who cares? If this thing really starts to move up, though, and it goes up to 278, which where the prior all-time high was, I'm really starting to crank up some of those gains, right? In a big way. And if it starts to come down, maybe it comes down to 255, my losses are manageable. And I am able to say, if I am wrong directionally and it's actually coming down, I am able to get out of this position without sustaining the full $1,600 loss because I can change my mind. The losses are going to be manageable, something that I can swallow, something I can live with. If it comes down to $250, $9 lower than here, is it still manageable? I would argue yes, relative to the reward potential of going and testing those prior highs or even going higher. You size these things up. If you don't like the structure in terms of the spreads or the widths, you change the simulation, right? You add another one, you add a spread, you add whatever you want, compare, contrast, stress test, execute. That's what it's all about. Jake, I'll leave it there. Last words to you, sir.
All right, folks. I hope this has been enjoyable. An interesting idea, the chance to trade. And here we focus a little bit on the ETF focused ideas. We've got a lot involved, and we went through things from volatility skew to the very basics of an ETF. If this was of interest to you and you'd like to continue to learn more, I would strongly encourage you to join Constantine tomorrow and every Wednesday for those volatility sessions where you dive deeper into those types of topics. If you felt like this was a little bit more advanced than you were ready for, another alternative would be for you to join into some of our options intermediate courses that dive into these topics and teach you from the ground up how you can work through the ideas. That can be found at fidelity.com/classroom. But folks, it's been our pleasure to spend the last hour together with you, and we wish you the very best. It's only Tuesday, and yet we've seen a full week's worth of market excitement already. We'll see how the rest of it plays out. Thank you for joining with us. We'll hope to see you back here soon. Until then, take care, everyone.
Take care, everybody. Thank you for the positive comments, all the emojis that are going through. Certainly makes our work worthwhile, I think, right? Always, always great to see that. We'll see you again soon. Take care, everybody. I will see most of you, I'm sure, in the volatility primer tomorrow. The regulars, that is. And those of you who are not regulars, hope you become the regulars. See you soon. Take care.